You just deposited your hard-earned paycheck at your bank a few days ago. Now you're ready to withdraw some funds for a weekend of fun. You walk up to the bank's door and push. It's locked. You look around. On the door is a sign that says, "Out of money." You begin to panic. Your entire life savings was in that bank and now it's all gone. How could this happen? What should you do? Will this snowball into an economic collapse? Don't worry, we got your back. It's very rare that a bank will run out of money, but it does happen. Most recently, Silicon Valley Bank has been forced to close, and anyone who had money at the financial institution is desperately trying to get their cash back. We'll use this as a case study for what happens when a bank runs out of cash. To understand what happened to SVB and other banks that have been forced to close, we need to examine the lead-up to this alarming situation. Before we go any further, it's worth mentioning that if your money was in an established bank that the Federal Deposit Insurance Corporation insures, you likely don't need to panic if your bank runs out of money. This is why it's important to bank with a reputable institution. We're going to discuss exactly what the FDIC does to protect your money, but the bottom line is that if your funds are in a checking or savings account at a major bank in the United States, the government will make sure that up to $250,000 of your cash is protected, no matter what happens to the bank itself. We'll look at what this means more in depth in a bit, but if your money is in a bank insured by the FDIC, you do not need to panic if your bank closes. A bank fails when it can no longer meet its financial obligations to creditors and depositors. So if the bank has bills to pay or doesn't have enough money for its clients to withdraw on demand, the bank might be forced to close. At a basic level, this is because the bank no longer has enough liquid assets to meet its payment obligations or its liabilities are greater than its assets. The easiest way to think about this is the bank is out of money when depositors or debtors ask for their funds and the bank doesn't have enough cash available to give it to them. But how could this possibly happen? Doesn't a bank store your cash in a huge safe along with gold bars and jewels? Or, at the very least, shouldn't a bank always have enough money to pay people back and institutions that trust it to hold their money? The answer to this question is a resounding nope. No financial institution has enough money sitting around to pay back all of its creditors and depositors at the same time. This is because the goal of a bank, like all businesses, is to make money. When you deposit your paycheck at a bank, the cash doesn't just sit in a vault. The bank invests your money in different assets like stocks, bonds, and other ventures. This hopefully allows your cash to grow so the bank can pay you interest, but also so they can make a profit. This means that at any given time, most of the money a bank has isn't just sitting around, but is tied up in investments. This is how banking is done and is necessary to avoid charging customers exuberant fees to keep the bank in business. Banks do typically diversify their portfolios to reduce risk and have cash available at any given time. It's just not enough to make huge payouts. That being said, every financial institution invests differently and some take more risks than others. Let's look at what happened to Silicon Valley Bank, why it happened, and what will happen in the future. This is a good case study for explaining the steps taken by any major bank to stop it from failing. We can also follow your money from start to finish to see how an institution whose main job is to safely hold your money could lose it. One of the first things that occur with any bank when it's in trouble is that it starts borrowing money from other solvent banks to meet its financial obligations, like paying back its depositors. If this doesn't work, panic within the organization will start to settle in. The bank will begin desperately selling assets or shares of its stock in order to raise funds. However, when this happens, it can make anyone with money in the bank nervous. These desperate actions can lead to a snowball effect, where even more depositors begin to worry and then start pulling their money out of the bank. At some point, the financial obligation of the institution becomes too great and regulators must step in. But let's backtrack. What caused this scenario to happen at Silicon Valley Bank? As you and everyone else in the world probably knows, inflation rates are brutal right now. The Federal Reserve is on a crusade to slow inflation using all the tools at its disposal. One of the most powerful instruments at its disposal is raising interest rates. When interest rates go up, people tend to spend less money, make fewer investments, and purchase fewer loans, which means more money is being kept within bank accounts that are incurring interest. However, this also has ramifications for banks' investments, especially if they have a lot of money tied up in low-interest bonds or in the stock market. This is one reason why Silicon Valley Bank found itself quickly running out of cash. During the pandemic, interest rates were at record lows as the government tried to keep the economy going. Higher interest rates encourage less spending, while low interest rates typically cause people to make more purchases and pump money into the economy. However, over the course of a year, interest rates have skyrocketed, which means that investors are taking less risks. You probably aren't shocked to find that Silicon Valley Bank holds the money of many tech companies due to its location and name. In fact, the primary clients of SVB are tech startups. This is a huge problem in a market where securing backers and investments is becoming harder and harder to do as interest rates continue to rise and the future of the economy is uncertain. What startups have been finding is that tracking down investors and going public has been extremely difficult recently, as people and companies have become more averse to risk. This has led to many startups with accounts at SVB to start withdrawing funds to meet their financial needs. Unfortunately, when many depositors started withdrawing simultaneously, SVB needed to scramble to create enough liquidity or available cash to meet their clients' demands. If this was only done by a few depositors, there wouldn't have been a problem. But when multiple startups needed large amounts of cash to satisfy their needs and withdrew funds at the same time, it led to a money flow problem for Silicon Valley Bank. In a general sense, when many depositors withdraw all their money at the same time, it's known as a bank run, and it's never good for the bank itself. SVB began selling $21 billion in bonds that it owned in order to meet the payout demands. The problem was that the U.S. Treasury bonds that the bank had invested in had a 1.79% interest rate. This is far below the 3.9% interest that the 10-year Treasury yield currently has, which means they were selling their bonds at a $1.8 billion loss. But the bank had no choice if it was going to save itself. SVB also asked investors and other institutions for additional capital in the form of equity or debt in what's known as a capital raise. When a bank does this, it's also raising some red flags, as it means the financial institution is having liquidity problems. Even more alarming was when Silicon Valley Bank announced it would sell $2.25 billion in stock to help it meet its financial obligations. Again, this was a huge warning to investors and people who had their money in SVB that something was seriously wrong. The stock ended up losing 60% of its value as investors sold their shares and the marketplace was flooded with SVB stocks that the bank was selling to raise funds. This in turn caused more people to pull their money from the bank as they were rightly afraid that it was running out of money. But this isn't a problem unique to Silicon Valley Bank. Any financial institution put under enormous strain to pay out clients in a short amount of time would need to take drastic actions to convert enough assets into usable cash to meet their depositors' demands. Once it became apparent to most investors and clients that SVB was in trouble, everyone jumped ship all at once, which sealed the bank's fate. In the very worst-case scenario, banks that have run out of money, like SVB, try and find funding through the sale or acquisition of the company. This is probably slightly easier when the economy is strong and businesses are looking to grow, but that is not the case right now. 3 days after it became apparent that Silicon Valley Bank was having cash flow problems, the FDIC stepped in. They shut down the bank and placed it under receivership. This meant that Silicon Valley Bank could no longer accept deposits, and regulators would operate under special rules to help the company recover losses, which was done so it could meet its existing financial obligations. Once regulators and the FDIC got involved, a failing bank can no longer operate as it used to. The goal is to keep the bank from going bankrupt, but that's easier said than done. So what does the FDIC do exactly? And what does it mean for people who have their cash in a bank that has run out of money? Perhaps the craziest part about a bank failing is that no one knows it's about to happen until it's too late. Since panic can exacerbate many situations for a bank, it's no surprise that financial institutions normally hide any indication they're in trouble until drastic measures need to be taken. Sometimes when banks need liquidity and start selling assets, the bank secures the cash it needs, and no one's the wiser. It's when these measures don't work that it becomes apparent to outside entities such as depositors and investors, and things go very badly very quickly. Normally, the FDIC will know something is wrong before people who have their money in a bank that is failing will. A financial institution that is in serious trouble will reach out to the Federal Deposit Insurance Corporation for help to remain out of bankruptcy. This often takes the form of the FDIC helping in the search for another bank to acquire the struggling one. Ideally, the buyer will have a stable revenue flow and enough cash on hand to satisfy the needs of the clients they receive in the acquisition. The government also has the ability to incentivize the acquisition and create ideal buying conditions. However, like with Silicon Valley Bank, they're not always institutions that can or are willing to take on the financial burden of a failed bank. In this case, the bank is forced to close. Once the FDIC takes over, they use the depositor records at the company to notify each account holder that their bank has been closed. It's important to note that the FDIC will never inform you of a bank closure by phone. These calls are scams and should not be engaged with. Unfortunately, in the world we live in, it's common for phishing calls to go out from bad actors trying to steal and swindle money from people who may be panicking because they've been put in an uncertain financial situation. This brings us to what happens to your funds if your bank runs out of money. Let's say that you have your entire life savings in a bank that's forced to close because it's run out of money. All measures taken to try to raise cash have failed, The FDIC got involved but was unable to find a buyer, and now your bank has been forced to shut down as it has completely run out of money. Does this mean all your capital is gone and you have to start all over? Luckily, no. We said it once and we'll say it again. When choosing a bank to deposit your hard-earned cash in, make sure that the institution is FDIC insured. If it's not, then your bank fails and you will in fact lose all your money. However, since the FDIC insures most banks in the US, your money is probably safe. When a bank runs out of money and is forced to close, the FDIC will reimburse you up to $250,000. This is great news if you have less than that in the bank, because it means you'll get all of your money back. But what if you have more than $250,000? This is where there are some tricks of the trade that you must know if you want to make sure all your money is safe. First, let's discuss why the Federal Deposit Insurance Corporation was established in the first place. During the 1930s, as the Great Depression gripped the U.S., the federal government realized that there needed to be a way to restore confidence in the banking system. Just to put this problem into perspective, around 4,000 banks either closed or suspended operations in 1933 alone. This is why Congress passed the Banking Act that year, which in turn established the FDIC. This new organization would insure money in banks so that people would not lose their deposits even if the bank failed. This helped the average American feel more confident in the banking system. Obviously, the wounds from the Great Depression would take time to heal, but the Banking Act and the creation of the FDIC definitely helped the process. So even today, if you have $250,000 or less in a bank, you shouldn't worry, as there is a safety net. The accounts covered by the FDIC include checking accounts, savings accounts, money market accounts, and certificates of deposits or CDs. However, it's important to note that the FDIC does not protect money in stocks, bonds, mutual funds, life insurance policies, annuities, or securities. But what if you have money in multiple accounts? The key here is that the FDIC will insure up to $250,000 per account holder at a bank. So hypothetically, let's say you have $100,000 in a savings account, $50,000 in a money market account, $25,000 in a checking account, all at the same bank. Since the grand total of the money deposited in your name is only $175,000, all of it is insured by the FDIC, even though it's in multiple accounts. Conversely, if you have $200,000 in one type of account and $100,000 in another at the same bank, $50,000 of your cash is not insured, and you'll likely lose that money if your bank failed. However, there are ways to get around this problem to ensure that all your money is protected. The FDIC insures joint accounts separately from single-owned accounts. So if you share a joint account with someone, you can have more of your money insured. Let's see how this works. The FDIC attributes 50% ownership to each person in a joint account. This means that regardless of where the money comes from or who deposits it, each person is insured for up to $125,000. This is because $125,000 times 2 people is $250,000, which is the maximum amount of money the FDIC will insure. So technically, if you have an account under your name and a separate joint account, you would actually get the FDIC to insure up to $375,000. But what if you have been extremely successful and have $1 million that you want to deposit? Is there any way to insure it all? You'd have a couple of options if this were the case. You could open accounts at different banks and put $250,000 in each. The FDIC insures accounts on a bank-by-bank basis. So if you were to open 4 accounts at 4 different banks and divide the million evenly between them, the FDIC would insure each one separately and all your money would be protected. There are also institutions with separate insurance policies that will insure accounts with more than $250,000, but you'd have to research several banks to find the best fit for you. So if a bank closes, how does the account holder get their money back? Is it as easy as the FDIC cutting you a check for the total amount you deposited? Surprisingly, it is. If your bank runs out of money and is forced to close, you don't need to do anything but wait. If the FDIC finds another financial institution that will acquire your bank, you'll get a new account number with the new institution where you'll be able to access your hard-earned cash. The FDIC will also make sure any direct deposits going into your old account are transferred over to the new one. If the failed bank is not acquired, it's a slightly different story. In this case, the FDIC will literally write you a check for the total balance they insured from your accounts, which will then be mailed to you. And even though each bank failure is unique, the FDIC tries to cut checks within 2 business days of a bank's closure. This could be a tense few days for anyone who had their money lost by the failed bank, but the FDIC claims it'll send payments as soon as possible so that people can deposit their lump sum check at a new bank and suffer as little financial stress as possible. In the Silicon Valley Bank case, many of the accounts had well over $250,000. This is because the clientele was mostly tech startups, and the bank had very few individuals who used SVB for their personal needs. This is part of the reason why account holders began to panic and pulled their money out as quickly as possible. They knew that if the bank ran out of money and closed, they would lose enormous sums of money because the FDIC doesn't typically insure over $250,000. However, the FDIC has said it'll make all depositors at the bank whole again, regardless of account size. This means that the government will somehow find the cash to ensure every account holder gets their money back. It's not completely clear how they'll do this, where the money has to come from, or even why they're insuring more than $250,000, but it probably has a lot to do with reducing panic and stabilizing the banking industry. Over the last several weeks, multiple banks have closed, so businesses and account holders are becoming more and more worried. And as we've seen, when people panic and begin pulling their money out of a bank simultaneously, it's a recipe for disaster. What it comes down to is that most of us don't need to worry about the money we've deposited in a bank, because the government insures it, and the majority of people don't have more than $250,000 in an account. It's also worth mentioning that a series of very unfortunate circumstances must happen all at once before most banks fail, and it's impossible to predict what the future will hold. That's why it's never a bad idea to diversify your portfolio and make sure your money is at an institution that does the same. Now watch What If the US Economy Crashes? Or check out What Will Russia's Economy Look Like in 5 Years?